Not if you have been following the headlines. Not if you have been watching the ETF flow data. Not if you have been listening to the institutional narrative that has dominated every major financial publication since the beginning of 2026. Because the headlines say billions are flowing in. The ETF data confirms it. The institutional names attached to those flows, BlackRock, Fidelity, Goldman Sachs, Standard Chartered, are not names that make reckless bets with capital at this scale. And yet, Bitcoin is trading at $80,000, down from a peak of $126,000. Ethereum is sitting around $2,300, down over 55% from its cycle high. XRP is near $1.40, down more than 60% from where it was trading just months ago. Solana is around $86, cut in half from its 2025 highs. BNB is the only outlier, quietly holding gains that the others have completely surrendered. Billions in. Prices down. 5 of the most institutionally adopted assets in the history of cryptocurrency, all of them bleeding simultaneously while the largest financial institutions on Earth are publicly, measurably, on record buying them. This is not a mystery with a single answer. It is a paradox with 5 layers. And each layer belongs to a different asset, a different mechanism, a different structural force that the bullish ETF narrative consistently fails to address honestly. By the time this video is over, you will understand exactly why the inflow number and the price number can both be true at the same time, and what that means for what comes next. Before anything else, nothing in this video is financial advice. Every asset discussed here is volatile, high risk, and capable of moving dramatically in either direction without warning. This is market structure forensics, historical pattern recognition, educational analysis. What you do with it is entirely your own responsibility, and you should always consult a qualified financial professional before making any decision with your capital. Let us start with the number that started this entire conversation. In April 2026 alone, spot Bitcoin ETFs recorded $2.44 billion in net inflows, the strongest single month since October 2025. Cumulative net inflows across all spot Bitcoin ETFs have now crossed $57 billion since their January 2024 launch. Ethereum ETFs have pulled in $1.44 billion cumulatively since November 2025. XRP ETFs crossed $1.44 billion in their own right. Solana ETF filings are progressing through regulatory approval. BNB's ecosystem is processing billions in daily transaction volume. The capital is real. The institutional commitment is documented, public, and verifiable. And Bitcoin is 37% below its all-time high. Right now, today, picture a river. Wide, powerful, visibly moving. You can see the water flowing. You can measure the current. You can calculate the volume. But somewhere downstream, there is a drain. And the drain is not visible from where you are standing. The river fills. The drain empties. The water level barely moves. That is the structure of the crypto market in 2026. The ETF inflow is the river. The drain has 5 different openings. 1 for each asset. And each drain works differently. This is what the financial press is not explaining. Not because the information is hidden, it is all in the public data, in the on-chain analytics, in the derivatives market structure, in the SEC filings, in the quarterly reports. It is not explained because the full picture is complicated, and complicated does not generate clicks the way a single bullish inflow number does. So the number gets published. The drain gets ignored. And retail participants stare at the chart wondering why the price refuses to follow the logic they have been handed. Let us open the first drain. Bitcoin. The most institutionally adopted, the most liquid, the most analyzed asset in the entire crypto ecosystem. And the one with the most structurally misunderstood price suppression mechanism of 2026. When spot Bitcoin ETFs record billions in inflows, the capital is real. But so is what is happening on the other side of the trade. Bitcoin's 30-day trailing funding rate on Binance reached -5% in late April 2026, against a historical norm of positive 8%. That is a 13 percentage point deviation from baseline. Bitcoin's long-short ratio simultaneously showed 52.5% shorts versus 47.5% longs, a rare short majority for an asset that is normally heavily net long in futures positioning. Every major altcoin, Ethereum at 67.6% long, Solana at 75.1% long, XRP at 70.9% long, was positioned in the opposite direction in futures, while Bitcoin alone carried this anomalous short majority. The explanation is a trade that retail participants are not running but are absolutely affected by. The basis trade. The carry trade. An institutional strategy that involves buying spot Bitcoin through an ETF while simultaneously shorting Bitcoin futures, not because the institution believes Bitcoin is going down, but because the spread between the spot price and the futures price represents a calculable, relatively predictable yield that does not require any directional view on Bitcoin at all. The institution is not bullish on Bitcoin. The institution is not bearish on Bitcoin. The institution is harvesting yield from the gap between two prices. The ETF buy registers as an inflow. The futures short registers as selling pressure on the derivatives side. Both are the same institution. Both are the same trade. The inflow number tells half the story. The funding rate tells the other half. Most coverage only prints the first number. This is what makes the Bitcoin drain so invisible. The institutional money flows in through one door and simultaneously exerts structural downward pressure through another door that most people do not know exists. And as more institutions run the same carry trade, the short majority in futures grows, the funding rate stays negative, and the price action reflects both forces neutralizing each other, creating the flat, grinding, sideways movement that has defined Bitcoin's price behavior across the first quarter of 2026. But basis trades unwind. They have a resolution mechanism built into their structure. When the shorts become too crowded, when every institution running the carry trade is positioned identically, a price move in the wrong direction forces covering. Shorts cover by buying. Buying accelerates the move. The squeeze feeds itself. The same structural pressure that has been suppressing Bitcoin's price on the derivative side becomes, when it unwinds, the accelerant for the next major move upward. Glassnode's Rodel ratio sitting at 4.5, the third highest reading in Bitcoin's history, with only the 2015 cycle bottom and the 2022 cycle bottom showing comparable readings, both immediately followed by sustained bull markets, suggests the long-term holder base is not distributing. The foundation is building. The drain is temporary. The river is permanent. Now the second drain. Ethereum. And this one is different from Bitcoin's because it is not about derivative structure. It is about something more fundamental. Something that lives inside Ethereum's own design decisions. Ethereum's price problem in 2026 is not a demand problem. It is a revenue problem. And the revenue problem was created by Ethereum's own scaling solution. Layer 2 networks, Arbitrum, Base, Optimism, Polygon, were built to make Ethereum transactions faster and cheaper by processing them off the main chain and settling the results back to Ethereum periodically. From a user experience perspective, this worked. Transaction costs dropped dramatically. Speed improved. Adoption on Layer 2 networks accelerated. But the unintended consequence is now fully visible in Ethereum's fee revenue data. When transactions happen on Layer 2 instead of the Ethereum base layer, the fees those transactions generate go to the Layer 2 operator, not to Ethereum. Coinbase base network alone, according to Standard Chartered's analysis, extracted an estimated $50 billion from Ethereum's market valuation by redirecting fee revenue away from the base layer and toward the Layer 2 operator. Ethereum's own scaling solution became its own revenue extraction mechanism. The EIP 1559 burn mechanism, which was designed to make ETH deflationary by destroying a portion of every transaction fee, now burns far less ETH than it did before Layer 2 adoption exploded, because fewer transactions are happening on the base layer where the burn mechanism operates. The result is that Ethereum is simultaneously the most important infrastructure layer in all of crypto, the settlement layer for trillions of dollars in Layer 2 transactions, the foundation of the largest DeFi ecosystem on Earth, the backbone of the tokenization infrastructure that every major financial institution is now building on, and an asset whose fee revenue model has been structurally undermined by the success of the very solutions it incubated. The paradox is complete and uncomfortable. Ethereum won the infrastructure war. The fee economics of winning that war are not straightforward. Picture an enormous toll highway. The most traveled road in the country. Every car that drives on it generates revenue for the owner. Now imagine that to reduce congestion, parallel roads are built alongside it that handle most of the traffic, and those parallel roads are owned by different operators who pay only a tiny fraction of their revenue back to the original highway. The original highway is still the most important piece of infrastructure. But the revenue picture looks very different from what it was when all the traffic had to use the main road. That is Ethereum's structural position in 2026. The Glamsterdam and Higota upgrades scheduled for this year target higher throughput, lower base layer costs, and native account abstraction, changes designed to make the base layer more attractive for high-value transactions while allowing Layer 2 to handle volume. Whether these upgrades rebalance the fee economics in Ethereum's favor is the single most important question for ETH's price trajectory over the next 12 months. The $1.44 billion in ETF inflows provides a floor. The Layer 2 revenue drain provides a ceiling. The price is the scar left by that collision. The third drain belongs to XRP. And XRP's drain is the most ironic of the five because it is created by the very asset that was supposed to be XRP's greatest strength. Ripple's escrow. To understand why $1.44 billion in XRP ETF inflows has not moved the price meaningfully higher, you have to understand the escrow structure that sits above every bullish data point in the XRP market. Ripple holds approximately 37 to 40 billion XRP in escrow accounts, locked on a monthly release schedule that has been operating since 2017. Every month, up to 1 billion XRP is released from escrow into Ripple's operational holdings. Not all of it gets sold into the market immediately. Ripple returns a portion back to escrow in subsequent months. But the structural supply pressure this creates is constant, predictable, and enormous. At XRP's current price of approximately $1.40, 1 billion XRP represents $1.4 billion of potential supply entering the market every single month. The total ETF inflow of $1.44 billion, achieved over months of accumulation, is being measured against a monthly supply release that can match it in a single calendar month. This is the arithmetic that the bullish XRP narrative consistently fails to address honestly. $1.44 billion in cumulative ETF inflows sounds enormous until you hold it next to the monthly escrow release number at current prices. The math becomes far less dramatic. The river is flowing in. The drain is releasing water at a rate that prevents the level from rising. And yet, exchange balances of XRP have dropped to multi-year lows. On-chain accumulation by large wallets is accelerating. Institutional whales accumulating approximately 11 million XRP per day according to CryptoQuant data. The SEC lawsuit that suppressed institutional adoption for 5 years concluded in August 2025, with XRP formally recognized as a digital commodity by both the SEC and the CFTC in March 2026. Singapore's central bank tested financial settlements on the XRP ledger. The Clarity Act, which would permanently cement XRP's commodity classification into federal law, is moving through Senate markup in May 2026. These are not narratives. These are structural changes to the asset's legal, regulatory, and institutional standing that did not exist 18 months ago. The escrow pressure is the drain. The regulatory transformation is the river. Both are real. The price is where they meet. The fourth drain is Solana's. And Solana's drain is the one that reveals the most uncomfortable truth about the current crypto market structure. Because Solana has arguably the strongest technical momentum of any major asset in the ecosystem right now, and the price is still 50% below its 2025 high. The reason is not Solana's technology. The reason is Bitcoin dominance. Bitcoin's BTC dominance currently sits at 58.2% of the total crypto market capitalization. The alt-season index, a measure of how broadly capital is rotating from Bitcoin into altcoins, is sitting near 16. A reading below 25 signals Bitcoin dominance. A reading below 25 means capital is not rotating. It is concentrating. When capital concentrates in Bitcoin, it does not simply stop flowing to altcoins. It actively pulls capital away from altcoins as investors reduce risk, consolidate positions, and seek liquidity. The larger the Bitcoin dominance reading, the stronger the gravitational pull toward the center. And the further an asset sits from the center, the further it is from Bitcoin's category, the more speculative its use case appears relative to Bitcoin's digital gold narrative, the harder the gravitational pull hits. Solana is fast. Its Alpenglow upgrade, replacing proof of history and Tower BFT with voter and rotor components capable of finalizing blocks in 100 to 150 milliseconds, is a genuine technical leap that no other major blockchain has matched. Its transaction volume has surpassed Ethereum's on multiple metrics. Its developer ecosystem is growing. Its institutional ETF filings are progressing. By every technical and adoption metric, Solana is winning in 2026. But in a market where Bitcoin dominance is at 58% and capital is concentrating rather than rotating, winning on fundamentals and winning on price are entirely different competitions. And right now, the price competition is being won by the asset at the center of the dominance chart, not the assets at the edges. But here is what the dominance chart also tells you if you know how to read it historically. Every prior period of elevated Bitcoin dominance, 2019, late 2022, early 2023, has eventually resolved through a rotation cycle. Capital that concentrated in Bitcoin eventually seeks higher beta. The altcoins that are positioned with the strongest fundamentals, the deepest institutional product penetration, and the most liquid market structures are the first to receive that rotation when it happens. Solana, with its ETF filings, its technical upgrades, and its transaction volume dominance, is positioned for exactly that rotation. The drain is temporary. It is called Bitcoin dominance. And Bitcoin dominance has a historical habit of peaking right before the assets it has been suppressing make their most significant moves. The fifth drain is BNB's. And BNB's situation is the most structurally complex of the five because BNB is the only major asset that has not followed the broader market's drawdown pattern. BNB is up 40% from its 2025 lows, the single strongest performer among the five assets in this analysis. Understanding why BNB diverged while everything else fell is as important as understanding why the others fell. BNB's price resilience in 2026 is inseparable from Binance's structural position in the global crypto market. Binance processes more trading volume than its next five competitors combined. BNB functions as the native fee token of the Binance Smart Chain ecosystem, as a discount mechanism for Binance trading fees, and as the primary liquidity instrument across the BNB chain DeFi ecosystem. When trading volume rises, and trading volume has risen dramatically in 2026 as volatility creates activity even in a declining market, BNB demand rises with it because every trade on Binance creates structural demand for BNB regardless of market direction. The Maxwell upgrade, which improved BNB chain scalability and throughput, combined with Tether Gold integration into the BNB ecosystem, created additional utility vectors that did not exist in prior cycles. BNB is not just a speculative asset. It is the fuel of the world's largest crypto exchange. And exchanges run on volume. Volume runs on volatility. The same market conditions that have hurt every other major asset have, counterintuitively, increased the economic activity that drives BNB demand. This is the BNB paradox, an asset that performs better when the market is turbulent than when it is calm, because turbulence means trading, and trading means fees, and fees mean BNB. But BNB's outperformance is not without structural risk. Binance's regulatory situation in multiple jurisdictions remains the single largest overhang on BNB's long-term trajectory. If regulatory action in a major market restricts Binance operations, the fee-driven BNB demand thesis weakens immediately. The asset's strength is directly coupled to one company's operational continuity in a way that Bitcoin, Ethereum, XRP, and Solana are not. The drain for BNB is not supply pressure, not dominance dynamics, not Layer 2 revenue extraction. The drain for BNB is single-entity concentration risk wearing the costume of ecosystem utility. The distinction matters, especially in a regulatory environment that is becoming more, not less, attentive to exactly that kind of centralized dependency. Now let us step back and look at all five drains together. Because the most important insight in this entire analysis is not what is suppressing each individual asset. It is what they all share. The single mechanism that explains why billions of dollars can flow into five different assets simultaneously and the price of those assets can still decline. The mechanism is simple and brutal and almost never stated clearly in mainstream coverage. Institutional ETF buying does not directly buy the asset. It creates a wrapper around the asset's price exposure. When Fidelity sells you a share of its Bitcoin ETF, Fidelity goes to the market and buys Bitcoin to back that share. The price impact of that purchase is real. But it is one purchase at one point in time for the exact amount of Bitcoin needed to back the ETF share that was just sold. There is no multiplier effect. There is no secondary pressure. There is no wave of follow-on buying that the ETF inflow creates. The $2.44 billion in Bitcoin ETF inflows created $2.44 billion in Bitcoin buying pressure. Full stop. And against that $2.44 billion, you had the basis trade shorting on the futures side, you had long-term holders who bought at lower prices taking profits at current levels, you had miners selling newly minted Bitcoin to fund operational costs, and you had macro-driven risk-off sentiment pushing capital out of every high-beta asset class simultaneously. The ETF is a vehicle. It is a real, important, structurally significant vehicle. But a vehicle does not determine the destination by itself. The road it is driving on matters. The traffic it is competing with matters. The macro conditions it is operating in matter. And in 2026, the road is macro headwinds, the traffic is supply pressure and derivative structure, and the conditions are a frozen Federal Reserve, elevated inflation expectations, and geopolitical uncertainty that periodically spikes risk-off sentiment across every asset class simultaneously. Here is what this means if you are watching all 5 assets. The capital structure of the crypto market in 2026 is not broken. It is evolving from a retail-driven speculative cycle to an institutionally dominated capital allocation framework. That evolution is, historically, a necessary prerequisite for the asset class to access the next tier of capital. The trillion-dollar pension funds, the sovereign wealth funds, the insurance company balance sheets that are not yet in crypto, they will not arrive until the institutional plumbing is installed, stress-tested, and operational. The ETF flows, the ETF inflows, the basis trades, the custody solutions, the regulatory frameworks, all of this is the plumbing. It is being installed right now. The water does not flow at full pressure while the pipes are still being laid. Every prior transformation of this kind in financial history, the institutionalization of gold after the 1970s Bretton Woods collapse, the institutionalization of emerging market equities in the 1990s, the institutionalization of real estate through REITs in the 2000s, went through an identical structural phase. Capital arrived before price fully responded. The infrastructure build preceded the valuation re-rating. The early institutional positioning happened when the asset class looked broken to the retail participants who were watching the price instead of watching the structure. The 5 assets in this analysis, Bitcoin, Ethereum, XRP, Solana, BNB, are not 5 separate stories. They are 5 chapters of the same story. The story of an asset class in the process of being absorbed by the largest pools of capital on Earth. And the absorption process is, by its nature, slow, structural, and price neutral in the short term before it becomes price decisive in the medium term.